If you're sitting on cash right now thinking you're being safe, I need you to hear this very clearly. You are not safe. You are slowly bleeding money every single day, and most people won't realize it until it's too late. The biggest risk in Arsenal loop is not the stock market. It's not real estate. It's not even a recession. The biggest risk is doing nothing. Cash has always felt like certainty, like control, like protection against the unknown. But in loop, that belief is no longer grounded in reality, and clinging to it may be one of the most expensive mistakes an investor can make. People think cash equals safety because it doesn't fluctuate on a screen, because it doesn't make headlines, because it doesn't cause anxiety the way markets do, but that calm is deceptive. While cash appears stable, it is quietly being eaten away by forces far more powerful than daily market swings. Inflation does not announce itself loudly. It works silently, steadily reducing what your money can actually buy. Every year prices rise, every year purchasing power declines, and if your cash is not growing at least as fast as inflation, you are losing wealth, even if the number in your account stays the same. That loss doesn't feel dramatic, which is exactly why it's so dangerous. In past decades, holding cash made sense because interest rates rewarded savers, governments carried manageable debt, and inflation remained relatively contained. That world no longer exists. Today, global debt is massive, fiscal deficits are expanding, and monetary policy has become reactive rather than preventative. These conditions create an environment where cash is structurally disadvantaged. You are not opting out of risk by holding cash. You are choosing a slow, predictable decline over visible volatility, and predictable loss is still loss. What makes this even more dangerous is the false confidence cash gives people. They believe they are being patient, waiting for clarity, waiting for stability, waiting for the right time. But markets do not reward waiting, they reward preparation. The longer cash sits idle, the more opportunity cost compounds against you. While your money stands still, companies continue to innovate, assets continue to generate income, and capital continues to flow toward product. Wealth is built by participation, not by observation. In loop, the global economy is defined by uncertainty, but uncertainty does not eliminate growth. It reallocates it. Those who understand this shift their mindset from avoiding movement to preserving value. Value preservation does not come from freezing assets, it comes from placing them where they can adapt. Cash cannot adapt. It has no mechanism to adjust to rising costs, currency debasement, or long-term structural inflation. It simply absorbs the impact, and over time that absorption turns into erosion. Many people justify holding cash by pointing to market crashes, recessions, or geopolitical instability, but history consistently shows that the greatest long-term damage occurs not from downturns but from being absent during recoveries. Missing even a handful of strong growth periods can permanently impair portfolio outcomes. Cash holders often re-enter markets late, driven by headlines rather than strategy, buying at higher prices after confidence returns. That is not risk management, that is reaction. True financial discipline is proactive. It acknowledges risk but refuses paralysis. In environments like loop, capital must be positioned, not hidden. This does not mean reckless speculation or blind optimism. Edition Cephal stirs Spifer Measure Sefersers Turis Polbel Sumstat this diverse. It means understanding that safety today is dynamic, not static. It means favoring assets that generate income, adjust with inflation, or participate in long-term productivity. Cash does none of these. It does not produce. It does not compound. It does not protect against policy mistakes or fiscal expansion. In fact, it is often the first asset to suffer when governments respond to economic pressure. Currency is a tool of policy, and policy prioritizes systems, not savers. That reality may be uncomfortable, but ignoring it is costly. Holding excessive cash is not a neutral decision. It is an active bet that the future will reward inactivity. History offers little evidence to support that bet. But the most resilient portfolios are built by acknowledging uncomfortable truths early, not by hoping conditions revert to what once worked. The idea that cash is king belongs to a different era. In today's environment, cash is fragile. It gives the illusion of control while surrendering real power. The goal is not to eliminate cash entirely, liquidity matters, but to recognize its role and its limits. Cash should serve strategy, not replace it. When cash becomes the strategy, growth disappears, protection weakens, and time works against you. In Uitzending Arserloop, the question is no longer whether cash feels safe. One of the most common and dangerous misconceptions in investing is the belief that risk can be eliminated by stepping away from the market, but risk does not disappear when you avoid it. It simply relocates. When people move everything into cash, they think they have escaped uncertainty. Yet what they have actually done is concentrate risk into a single silent place, their future purchasing power. Risk is not defined by price movement alone, it is defined by the probability of failing to meet future needs. Inflation, currency dilution, policy shifts, and economic restructuring are all risks, and they operate whether you participate in markets or not. By holding cash, you are not opting out of the system, you are fully exposed to its weakest protections. This is the uncomfortable truth most people avoid because volatility feels more frightening than erosion. Market declines are visible and emotional, while the slow decay of money is invisible and rationalized. But invisibility does not make it harmless. In fact, it makes it more dangerous. In Uitzending Arserloop, the global financial system is navigating unprecedented levels of government debt, political pressure on central banks, fragmented supply chains, and rising geopolitical tension. These forces do not create a risk-free environment. They reshape where risk lives. When investors refuse to engage, they are not avoiding these forces. They are absorbing them without compensation. Risk must be paid for, either through returns or through loss, and cash offers no return sufficient to offset the risks it carries. True risk management is not about hiding from uncertainty, it is about distributing exposure intelligently. Diversification exists for a reason. No single asset class is safe in all conditions, but a thoughtfully constructed portfolio can adapt as conditions change. Cash, by contrast, is static. It cannot respond to inflation, it cannot adjust to growth, and it cannot hedge against policy mistakes. When interest rates change, when currencies weaken, when fiscal decisions reshape economies, cash simply reflects the outcome. It never anticipates it. Many people justify cash hoarding by saying they will wait until things calm down, but history makes one thing very clear. Clarity usually arrives after opportunity has passed. Markets move ahead of headlines, not behind them. By the time risk feels acceptable, prices have already adjusted. This is why so many investors buy late and sell early, not because they lack intelligence, but because they misunderstand. They treat risk as something to be avoided rather than something to be managed. In reality, avoiding all risk is itself the riskiest strategy of all. It guarantees underperformance over time. It guarantees missed compounding, and it guarantees that inflation, taxes, and opportunity cost will do the damage quietly. In periods of structural change, like the one we are living through now, capital is constantly being repriced. Assets tied to productivity, innovation, and cash flow adjust. Businesses raise prices, infrastructure generates income, and well-positioned investments evolve. Cash does not evolve, it remains fixed while the world moves around it. That creates a widening gap between those who accept managed risk and those who attempt to eliminate it. The irony is that the investors most afraid of losing money are often the ones most exposed to long-term loss. They trade short-term emotional comfort for long-term vulnerability. Risk, when understood correctly, is not an enemy. It is a tool. It can be shaped, diversified, and aligned with time horizons. But when you refuse to engage with it, it becomes concentrated and uncontrolled. In Uitzending Arserloop, the question is not whether risk exists. It does, everywhere. The real question is whether you are being compensated for bearing it. Cash provides no such compensation. It absorbs shocks without protection and erosion without resistance. Intelligent portfolios acknowledge that uncertainty is permanent and build structures that can survive it. That means spreading exposure, favoring quality, maintaining flexibility, and accepting that some volatility is the price of long-term stability. The belief that safety comes from standing still is a comforting myth, but history has never rewarded those who cling to it. Risk doesn't vanish when you step aside, it waits. And when it shows up where you least expect it, inside the very asset you believed would protect you. One of the costliest mistakes investors make is believing that success comes from timing the market rather than committing to discipline, because timing relies on prediction, and prediction is fragile in a world that constantly changes. People wait for the perfect moment, the clean signal, the point where uncertainty disappears, but that moment rarely arrives, and when it does, prices have already moved. Markets do not reward hesitation, they reward consistency. Discipline is not exciting, and that is precisely why it works. It removes emotion from decision-making and replaces it with structure. In environments like Arsenal-Archeloop, where headlines shift daily and narratives change weekly, reacting emotionally is a guaranteed way to underperform. The disciplined investor understands that volatility is not a signal to retreat, but a condition to operate within. Long-term wealth has never been built by guessing bottoms or tops. It has been built by staying invested through cycles with a plan that accounts for uncertainty rather than pretending it can be avoided. Every major period of economic disruption has produced the same pattern. Fear pushes people out at the worst possible time, and confidence pulls them back in after opportunity has passed. This cycle repeats because human behavior does not change even when markets do. The future does not reward those who wait for certainty. It rewards those who prepare for uncertainty, because economic progress has never moved in straight lines or paused to accommodate hesitation. Change arrives unevenly, often quietly at first, then suddenly and decisively. And by the time it feels obvious, the advantage has already shifted. Prepared capital understands this reality. It does not sit idle, waiting for permission from headlines or comfort from consensus. It is positioned with intention, designed to function across a range of outcomes rather than dependent on a single forecast being correct. In Arsenal-Archeloop, preparation matters more than prediction because the forces shaping the global economy are structural, not temporary. High debt levels, evolving monetary policy, demographic shifts, technological acceleration, and geopolitical realignment are long-duration trends that will not resolve neatly or quickly. Investors who wait for clarity before acting misunderstand how markets work. Markets move ahead of certainty, not behind it. Prepared capital moves with that understanding. It accepts that volatility is not a signal of failure, but a feature of transition. Rather than attempting to avoid every drawdown, prepared investors design portfolios that can absorb shocks and continue operating. This means prioritizing quality over speculation, balance over concentration, and resilience over short-term performance. Prepared capital is diversified not only across assets, but across behaviors. It generates income, participates in growth, maintains liquidity, and adapts as conditions evolve. It is not frozen in cash nor recklessly deployed. It is strategically positioned. One of the most damaging habits investors have is equating preparation with pessimism. In reality, preparation is confidence grounded in realism. It acknowledges that downturns will occur, that cycles will turn, and that stress will test assumptions. Instead of reacting emotionally when those moments arrive, prepared investors rely on frameworks built in advance. They rebalance instead of retreating. They add selectively rather than panicking. They understand that markets often recover before sentiment improves, and that waiting to feel comfortable usually means arriving late. Prepared capital benefits first because it is already engaged when recovery begins. This is not luck, it is structure. Structure replaces emotion with process and transforms uncertainty from a threat into a manageable condition. In contrast, unprepared capital reacts defensively, often at the worst possible moments. It moves out after losses have occurred and hesitates to re-enter until prices have risen, locking in underperformance. The difference between these outcomes is not intelligence or access to information, it is readiness. Everyone sees the same headlines. Only prepared investors act rationally when others cannot. In Arsène Lupin, preparedness also means understanding that no single asset or strategy will dominate indefinitely. The era of one-directional markets has ended. Returns will be uneven, correlations will shift, and assumptions that worked in the past will be challenged. Prepared capital is flexible. It allows for adjustment without abandonment. It recognizes that discipline does not mean rigidity. It means commitment to principles while adapting tactics as conditions change. Liquidity is maintained not to hide, but to respond. Risk is taken not impulsively, but deliberately with an understanding of time horizon and purpose. Prepared investors do not chase every opportunity, nor do they fear missing out. They know that opportunity is constant, but capital must be positioned to recognize it. The future rewards those who are early, not those who are certain. And being early requires the courage to act when outcomes are not guaranteed. That courage is not emotional, it is structural. It is built through planning, diversification, and long-term alignment. Prepared capital does not depend on perfect forecasts or flawless execution. It depends on endurance. It survives mistakes because no single decision defines the outcome. It compounds because it remains engaged. Over time, this consistency becomes an advantage that cannot be replicated by reactionary behavior. In a world where uncertainty is permanent, readiness is the most valuable asset an investor can possess. The years ahead will not be defined by who avoided volatility, but by who navigated it with purpose. Those who prepare will not avoid discomfort, but they will move through it with control. And as capital continues to flow toward productivity, innovation, and resilience, the future will reward those who were positioned before confidence returned, not those who waited for it. The disciplined investor understands that volatility is not a signal to retreat, but a condition to operate within. Long-term wealth has never been built by guessing bottoms or tops. It has been built by staying invested through cycles with a plan that accounts for uncertainty rather than pretending it can be avoided. Every major period of economic disruption has produced the same pattern. Fear pushes people out at the worst possible time, and confidence pulls them back in after opportunity has passed. This cycle repeats because human behavior does not change even when markets do. Discipline interrupts this cycle. It enforces actions when emotions resist them. It encourages measured allocation when fear dominates and restraint when greed takes over. In Arsène Lupin, this matters more than ever because the market environment is shaped by structural forces rather than short-term events. Interest rates, debt levels, demographics, technology, and geopolitical shifts are not temporary disturbances. They are long-duration trends. Waiting for them to resolve before investing is equivalent to waiting forever. The disciplined approach accepts that uncertainty is permanent and builds around it. That means investing gradually rather than all at once, rebalancing instead of reacting, and focusing on quality instead of chasing momentum. Time in the market has consistently proven more powerful than timing the market because compounding requires exposure, and exposure requires commitment. Cash sitting on the sidelines earns nothing from time itself, while invested capital compounds quietly, even during difficult periods. This is often misunderstood because short-term losses feel more painful than long-term gains feel rewarding. But emotion is not a reliable guide for financial decisions. The disciplined investor measures success not by short-term performance, but by adherence to process. Process creates predictability in outcomes even when markets are unpredictable. This does not mean ignoring risk. It means defining it in advance. Allocations, limits, and rebalancing rules exist so decisions are made when thinking is clear, not when emotions are loud. Investors who lack discipline outsource decisions to headlines, social media, and noise, constantly adjusting their strategy based on what feels urgent rather than what is important. Over time, this behavior erodes confidence and capital. Discipline, on the other hand, builds resilience. It allows investors to endure drawdowns without abandoning strategy and to benefit from recoveries without hesitation. In Arts-Handling Arsaluk, discipline also means resisting the temptation to overreact to short-term economic signals. Markets often price in fear long before it materializes and begin recovering long before data improves. Those who wait for confirmation consistently arrive late. A disciplined framework anticipates this reality and remains engaged. It recognizes that progress is uneven, returns are lumpy, and patience is a competitive advantage. The most successful investors are not those who are always right, but those who are consistently prepared. They accept that mistakes will occur, but ensure no single mistake is catastrophic. This mindset transforms investing from a guessing game into a system, and systems outperform instincts over time. Discipline is not about being aggressive or conservative, it is about being intentional. It aligns capital with long-term objectives and refuses to let short-term fear rewrite the plan. In a year like Arsenal Arshuluk, where uncertainty is amplified and narratives compete for attention, discipline is the difference between reacting and leading. Those who rely on timing will continue to wait for permission that never comes. Those who rely on discipline will continue to compound quietly and steadily, while others remain on the sidelines wondering why progress feels so elusive. As we step into Arsenal Arshuluk, the most important realization investors must confront is that the old definitions of safety no longer apply, and clinging to them out of habit is not prudence, it is vulnerability. The world has changed structurally, not temporarily. Debt levels are higher than ever, policy decisions are increasingly reactive, geopolitical tensions are persistent, and economic cycles are shorter and more unpredictable. In this environment, comfort is expensive and complacency is dangerous. Holding excessive cash may feel reassuring, but feeling safe and being protected are not the same thing. True financial security is not built by avoiding uncertainty, but by preparing for it with clarity, discipline, and intention. Wealth is not preserved by standing still while the world moves forward. It is preserved by positioning capital where it can adapt, respond, and grow over time. The biggest mistake investors make is believing they will recognize the right moment to act when it arrives. History shows that moments of clarity are rare, and opportunity often looks like discomfort when it matters most.